I was talking to a friend of mine last week, smart guy, engineer, makes good money, and he told me something that just about knocked me off my chair. He said, Warren, I'm doing great. My portfolio's up 40% this year, all in tech stocks. And I asked him, what happens when tech has a bad year? He looked at me like I just asked him what happens if the sun doesn't come up tomorrow. Here's the thing. And listen carefully because this might save you decades of heartache. That's not investing. That's gambling. And the house always wins eventually. Let me share something with you that Wall Street doesn't want you to understand. In the last 100 years, we've had the Great Depression, Black Monday in 1987, the dot-com crash, the 2008 financial crisis, and the COVID market collapse. That's roughly one major crisis every 20 years. Now, if you're 30 years old today and you plan to retire at 65, you're going to live through at least one, probably two major market catastrophes. Most people don't realize this. They build their entire retirement strategy based on the assumption that what worked last year will work next year. That's like driving by looking only in the rearview mirror. Here's a statistic that should wake you up. According to a Dalbar study analyzing investor behavior from 1984 to 2020, the average equity fund investors earned just 5.5% annually, while the S&P 500 returned 10.2%. That's nearly a 50% difference in returns. Why? Because most investors panic and sell during downturns, then buy back in when prices are high again. They're doing exactly the opposite of what they should be doing. Now you might be thinking, well, I'll just pick the right stocks at the right time. Let me tell you something. I've been doing this for over 7 decades, and I can't consistently time the market. Nobody can. Not me, not the smartest people at Goldman Sachs, not your brother-in-law who made money on cryptocurrency. Here's what most people don't realize. The question isn't how to build a portfolio for a bull market or a bear market. The real question is, how do you build a portfolio that survives and thrives in any market? Think about it like this. You wouldn't build a house that only stands up in good weather, would you? You'd want a foundation that holds whether it's sunny, raining, or there's a hurricane coming through. Your portfolio needs the same kind of foundation. Let me show you some numbers that'll make this crystal clear. Say you have $100,000 invested and the market drops 50%. You now have $50,000. Simple math, right? But here's where it gets really interesting. To get back to $100,000, you don't need a 50% gain. You need a 100% gain. You've got to double your money just to break even. That's the asymmetry of loss. It's far, far more painful than the pleasure of gain. During the 2008 financial crisis, the S&P 500 lost about 37%. If you had $500,000 in an all-stock portfolio, you'd be looking at $315,000, and it took nearly 4 years to recover to the same level. 4 years of your life just to get back to square one. But if you'd had an all-weather portfolio, and I'll explain exactly what that means, you might have only lost 15–20%. That's the difference between sleeping soundly at night and lying awake, wondering if you'll ever be able to retire. Now here's the part that most financial advisors won't tell you because it doesn't sound exciting. Building wealth isn't about hitting home runs. It's about not striking out. I want you to understand something about human psychology. We're wired to remember our wins and forget our losses. Your friend who made 40% in tech stocks this year? He's not telling you about the year he lost 30%. Our brains literally suppress those memories. This is where the real shift needs to happen in your thinking. Stop trying to maximize returns. Start trying to minimize the chance of permanent loss. Berkshire Hathaway's first rule is simple. Don't lose money. Rule number 2. Don't forget rule number 1. That's not a joke. That's the foundation of everything. Let me break this down in a way that makes sense. An all-weather portfolio is designed to perform reasonably well across 4 different economic environments: growth, inflation, deflation, and recession. Most people put 100% of their eggs in the growth basket. When growth stops, they're devastated. Here's a basic framework, and I want you to really think about this. 40% in long-term bonds. These perform well during deflation and recession. When everyone's panicking and pulling money out of stocks, bonds tend to hold steady or go up. 30% in stocks. Yes, only 30%. These give you growth during good times, but you're not betting the farm on them. 15 chicas in intermediate-term bonds. Different maturity dates give you different risk profiles. 7.5 in gold. I'm not a huge gold fan personally, but it's insurance against currency devaluation and performs well during inflation. Percent in commodities. These also hedge against inflation. Now, you might be thinking, Warren, that seems too conservative. I'll never get rich with only 30% in stocks. And that's exactly the mindset that keeps people poor. Let me show you what this actually means in dollars and cents. Let's say you start with $100,000 and invest for 30 years. If you put it all in the S&P 500 and get the historical average of 10% per year, you'd end up with about 1.75 million. Sounds great, right? But that assumes you never panic and sell during a crash. And based on that Dalbar study I mentioned, most people don't get anywhere near the full return because they can't handle the volatility. With an all-weather approach, you might average 7 to 8% per year. That gives you $1 to $1.2 million over the same period. But here's the kicker. You're far more likely to actually achieve that 7 to 8% because you won't panic and sell when things get rough. The portfolio is designed to be smooth, steady, and psychologically bearable. A guaranteed 1.2 million beats a theoretical 1.75 million that you'll never actually get because you sold everything during the crash. Now this is where it gets really interesting, and this is the part that separates people who build wealth from people who just talk about it. Every year, like clockwork, you rebalance back to your target percentages. Let's say stocks have a great year, and they go from 30% of your portfolio to 40%. You sell some stocks and buy more bonds to get back to 30, 40, 15, 7.5, 7.5. Wait, you're saying, you want me to sell my winners? Yes. That's exactly what I'm telling you to do. Because here's what you're actually doing. You're selling high and buying low, automatically, without emotion, without trying to time the market. During the 2008 crisis, while everyone else was selling stocks in a panic, an all-weather portfolio would have had you buying stocks with the money from your bonds. That had gone up in value. You'd be buying when stocks were on sale. That's not genius. That's just discipline and a good system. Now, I can already hear some of you saying, but Warren, what about inflation? What about taxes? What about my individual situation? Great questions. Let's tackle them. On inflation. This portfolio is specifically designed to handle inflation through the gold and commodities allocation. When inflation rises, these assets typically increase in value to offset the declining purchasing power of your bonds and cash. On taxes. Use tax-advantaged accounts like 401ks and IRAs for this strategy. Do your rebalancing inside these accounts where you won't trigger capital gains taxes. If you're investing in a taxable account, be strategic about when you rebalance and consider using municipal bonds for the bond portion. On individual situations. This is a starting framework, not a one-size-fits-all solution. If you're 25 years old, you might tilt years more towards stocks. If you're 60, you might want more bonds. But the principle remains the same. Diversification across different economic environments. Let me tell you about my friend Tom. 20 years ago, Tom had $200,000 saved up. He was 45 years old and planning to retire at 65. He put it all in an index fund because someone told him that's what smart investors do. Then 2008 hit. His portfolio dropped to $130,000. He panicked and sold everything, moving to cash. He waited until 2012 to get back in, by which time the market had already recovered most of its losses. He'd locked in his losses permanently. Today at 65, Tom has about $400,000. Not bad, you might think. But if he just held on and never sold, he'd have over $1.2 million. And if he'd had an all-weather portfolio and rebalanced during the crisis, buying stocks when they were cheap, he'd probably have $1.5 million. That's the difference between a comfortable retirement and a luxurious one, all because of psychology and lack of a proper system. Here's what I want you to do starting today. Step 1. Calculate your current allocation. Write down what percentage you have in stocks, bonds, cash, and other assets. Most of you will find you're 80 to 100% in stocks, and that should concern you. Step 2. Determine your target allocation based on your age, risk tolerance, and goals. Use the framework I provided as a starting point, but adjust for your specific situation. Step 3. Create a rebalancing schedule. Put it in your calendar. Once a year, same day, every year. I do mine on my birthday because it's easy to remember. Step 4. Automate everything you can. Set up automatic contributions to your investment accounts. The less you have to think about it, the more likely you are to stick with it. Step 5. Write down your investment philosophy and keep it somewhere you'll see it during market panics. Mine says, I will not panic and sell. I will rebalance according to my plan. Short-term losses are the price of long-term gains. Here's the thing nobody wants to hear. Building wealth is boring. It's not exciting. It's not going to make you feel like a genius at cocktail parties. You know what does make you feel like a genius? Having enough money to retire comfortably while your friends are still working at 70 because they kept chasing the next hot stock. The market rewards patience, discipline, and rationality. It punishes impulsiveness, emotion, and overconfidence. An all-weather portfolio isn't designed to make you rich overnight. It's designed to make sure you're still in the game when everyone else has been knocked out. Remember, it's not about timing the market. It's about timing the market with a strategy that lets you sleep soundly, regardless of what's happening on Wall Street. The best time to build an all-weather portfolio was 20 years ago. The second best time is today. Don't wait for the perfect moment. Don't wait until you understand it better. Start now with whatever you have and adjust as you learn. Your future self will thank you. And that's really all there is to it. If this video helped you understand why you need a different approach to investing, do me a favor, share it with someone who needs to hear it. Leave a comment below about what percentage of your portfolio is in stocks right now. No judgment, just honest conversation. And remember, the goal isn't to beat the market. The goal is to reach your financial goals without taking unnecessary risks. Now get out there and build something that lasts.